Welcome to the August 2023 monthly motor checkup. When is it ever not confusing? At the top. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. So when is it ever not confusing? At the top. Declines of 5 to 10% happen several times each year. So from what we can tell at this point, and we'll walk through this evidence, what we're seeing so far is nothing different from an ordinary decline in the context of an ongoing recovery from a bear market. The line in the sand is always what kind of damage is done to the underlying structure of the market during the pullback. And again, as of this moment, there's no dire destruction being done. We do want to be very mindful of the idea that our long-term risk gauge has yet to actually endorse a risk-on scenario. So that does open the door to the possibility that this rally that we are seeing is just a bear market rally in the context of an ongoing secular bear market, which could result in just a big sideways range for a number of quarters yet to go, or even a test of the October low. So we've seen this in the past in the 1930s, in the 1970s, in the 2000s, early 2000s, where we have a substantial rally that just gives way to enough weakness to allow for a continued sort of congestion within the range and possible test of the lows. At this point, which we'll walk through, we don't see that in the cards. We actually kind of like how the correction is unfolding, but we want to be mindful that the underlying longer term structure of the market, the structure of the market that's actually driven by fundamentals, has not yet inflected to risk on. I do want to say this again as something that I've said basically since the banking crisis, but let's not forget what has actually been thrown at this market. And despite all of the bad news, including most recently yet another debt downgrade of U.S. government debt, the market's been remarkably resilient, and leadership remains cyclical throughout. So very confusing, lots of conflicting messages, but at the end of the day, the message of the market seems to be the only thing that's actually is clear, which is the market has a positive outlook for the next several months and into 2024. This can change, of course, but we want to be mindful of the fact that as it stands at the margin, things are positive. Again, we don't want to be complacent because of we have yet to get endorsement from our longer term models, and the environment for the most recent debt downgrade is very different from what it was in 2011. So we don't want to be complacent. We just don't yet see it in the data that would suggest that the market cares about any of that at this point. So we'll walk through all those items as we go through this video this month. This is a chart that I've featured several times in the weekly motor reports and charting my interruptions and other notes. But we try to isolate these support and resistance areas before we get there, so that when we get there, we're not talking about concerns about failure in the heat of the moment. We wrote about them before this 45 to 4,700 area before we got there, warning that we should expect to see a decline here. So now that we're getting it, there's no reason to freak out. This is exactly where we should have failed. The bigger, more important question is, are we seeing any trend destruction on the way down during this correction? And are we seeing any supports broken? So after achieving this level here, we identified this support zone, which we refer to as the momentum support, which is we need this support zone to hold in order to keep the momentum off of this low alive, such that we can anticipate stronger second half earlier rather than later. If we can't hold this 43.25, that just means that we have a deeper test coming, perhaps your traditional August-September swoon that gets you down to 42 to 4,300. But the bigger thing to keep in mind is that all of that, even if in the worst case scenarios, it's a 6 to 8% decline off the peak, which again, as I said earlier, is very normal. It's not something to be all concerned about, because these 6 to 8% declines happen regularly on a regular basis throughout the course of bull market. So we want to be mindful of that and just be more focused on whether or not there's any damage being done, and less focused on the fact that we're declining. So this is a quick slide to just highlight this idea that the risk of a secular bear market thesis is still real and alive and kicking. So when you look at our risk gauge across 3 timeframes, we're doing short-term, medium-term, and long-term. We have 5 ingredients that go into each of these timeframes: price trend, relative cross-sectional momentum, breadth, and volatility. And when you look at all of those things in that long-term time frame, the fundamentally driven time frame, we can see that the risk gauge has yet to get even above the midpoint of mixed, let alone get into risk on. So from that perspective, it's possible that that this segment of the risk gauge rolls over again, and we endure another leg down in the in what would then be a secular bear market. But what's most important right now is that the damage that we're experiencing, to the extent that we are, is all being inflicted in the short term, and we'll walk through that as we go here. But you know, this is our trend setup table, which most of you should be familiar with by now. But what we're looking at is there's the trend structure can either be positive or negative, and then if it's positive, it can either be trending or basing. And if it's negative, it can either, of course, be trending or basing. And then there's different categories within. And what we're able to do once we've done this is we can track this over long-term, medium-term, and short-term, and then identify where the majority of the market is in each of those conditions. And much like you see here with the risk gauge at 6, not quite endorsing a risk-on environment, we can see that here. Only 46% of the market's in an uptrend in this time frame. So on the one hand, it does keep alive the risk that this is just a bear market rally and everything's now overbought in the context of this downtrend. But the more optimistic spin on it is that 2022 was all about chopping wood and breaking charts and creating a lot of destruction, and all that destruction, like anything else, growth, it follows periods of destruction. And so the bigger the pile of wood, the bigger the fire to follow. And the bullish spin on all of this, the fact that this is only 46%, is to say that, well, that means that 54% of the market is still is basically a large pile of wood that's yet to be burnt, and so therefore it's fuel for the next bull market. So we kind of lean on that as being the bull scenario, and we're willing to do that because the medium term and short term timeframes are still positive. And as long as these are inflecting higher, this whole concept is fractal. So the quarterly time frame, this cannot possibly start ticking down again until these start ticking down. And so we're very intently focused on these 2 timeframes to make sure that they're not doing that. And this table is as of last Friday, and I'll show you what it looks like as of last night, a snapshot of what destruction, if any, we've seen so far. But as of right now, we can see that in the medium term and short term timeframes, the majority of the market is trending positive, and the biggest buckets are up here in the trending positive area. It is worth noting that when you look at this analysis by market cap in buckets, instead of what percentage of the stocks are in each of the buckets, but instead what percentage of the market cap is in the buckets, we can see that, as we've been referring to in that MOTR management index, which is an index of the 9 largest companies that have sort of driven the S&P higher this year, 24% of the market cap is actually in a downtrend. It's a fresh downtrend, recently broken down, and it's not extended. That's a downtrend too. Despite that, 62% of the market cap is still in an uptrend. So we have a bit of a conflict here, but nonetheless, most of the market cap is still in an uptrend. So we're down about 5%. We're still above supports, that 43.25 area that I mentioned earlier. And despite all that weakness, we've still got an underlying structure that's still positive. The risk gauges in short term and medium term are hovering just below risk on. So as far as we're concerned, and from what we can see, we're navigating this correction rather well. When you look at the current condition of the sort of short term momentum, we can see that 16% of the MOTR universe, which is about 2,500 stocks, only 16% of that universe is above its 15-day average, and only 36% are above the 50-day average. So in the context of this corrective period that we're experiencing, we're now quite oversold, and we're still above support. So this is an environment or a location in a condition that really sets the stage for a nice snapback rally here. And so that's what we'd be looking for. If we don't get a snapback rally in here, despite the fact that we're this oversold, that would be troubling and concerning, but we still nonetheless wouldn't respond to it unless it was a material break in the structure of the market. The other thing we're watching for is the percentage of stocks that are above their 200-day moving average. And I mentioned this in one of our recent weekly motor reports. I want to see this number hold above 40 during this corrective period. And I want to see the percentage of stocks where they're rising 200-day average not get back below 50%. So as you can see, with this ongoing correction, these two numbers are still quite healthy. So looking as of last night's data, taking a look at what's happened to actual trend structure and to the trend setups that I just showed you on the prior page. As of right now, we're still seeing very resilient trend structure in the long term and medium term. We're still at 46% uptrend on the long term, and we've only seen a marginal fractional downtick on this medium term. So we've seen 15 stocks break down from an uptrend to a downtrend. We've seen 81 stocks give up their uptrends and just go into consolidation, all of which is netting out to a very marginal, very small decline in the percentage of stocks in an uptrend. In a 2,500 stock universe, it's now at 59% instead of 60%. So again, we've navigated through this normal bull market correction and have barely touched the long-term and medium-term trends. Where we've seen the majority of the destruction is indeed in the short term, but even there, 54% of the market still has a positive trend structure in that short term. What we have seen is 200 stocks actually reverse from positive to negative. We've seen 238 stocks give up the momentum of their uptrend and just kind of fall into a consolidation of that uptrend, all of which nets out to a 7.6% decline in the percent of stocks in an uptrend, but nonetheless, it's still 54%. So here we are above 43.25, above momentum supports, quite oversold, and still the majority of stocks are in an uptrend in that short-term time frame. So all the damage has been done here, and despite all that damage being done here, it's still tilting towards positive. Now, one other thing to keep in mind too is in light of the sort of working thesis, potential thesis that we're seeing nothing more than a bear market rally, secular bear market rally off the October bottoms. This chart in many ways supports that thesis. Again, I'm not endorsing it, but I'm just showing you that this is where we are as of the beginning of the bear market in January of 2022. We can see that the S&P itself, these are all equally weighted sectors in the market itself. The S&P is still down over 7% from its peak. So a lot of destruction still overhangs the market. There's been a lot of damage that has yet to be repaired, and we can see that only two of the sectors are actually up since the bear market began. So that's energy and industrials. And then industrials, we've been all over that one, equally weighted. This has been our number one sector for many, many months. But you can see that there's a lot of damage. So even technology, which is here, is still down 12.5%. And we still have some significant bear markets in financials, media, and REITs still ongoing. So again, one could spin this as being that the bear market is still ongoing, but others like ourselves, based on the inflections of the data at the margin, we view this as being a very large pile of wood that's been chopped over the course of the past 18 months and is just awaiting the spark to light that pile of wood on fire and fuel the next bull market. That's our working thesis. Many reasons go into that viewpoint, one of which perhaps is most important is the current sector leadership. When you look at the leadership of the market, it's industrials, tech, discretionary, energy, and materials. And believe it or not, financials is right there at number 6, despite what we're seeing in banks, and we'll cover that in a moment. But if you hold to the view that the market, there's infinite wisdom in the market, there's wisdom in price, the market looks forward better than anybody, and it's a weighing machine in Benjamin Graham's own phraseology. It's a weighing machine that knows that does a very good job of identifying the future. If the market was concerned about what it saw when it looked into the future, it's very doubtful to me that this would be the leadership of the market. So with the underlying trend structure not quite bullish yet, but certainly inflecting positive and actually holding up well during this corrective period, and the sector leadership remaining very cyclical, I'm of the mind that we're just going through a corrective period in this ongoing turn in the structure of the market from bearish to bullish. I mentioned earlier about all the things that have been thrown at the market. Of course, the 3 of the 4 largest bank failures in U.S. history, and all the other things that have happened most recently, the debt downgrade from Fitch just recently. So I thought it would be interesting to take a look at what happened the last time the U.S. debt was downgraded by S&P in 2011, almost 12 years ago to the day. Keep in mind, too, that this downgrade actually followed the global financial crisis, the European debt crisis, and you can even throw in the 2010 flash crash to boot. So you can imagine that investor nerves were very raw in this moment. And so therefore, when the debt downgrade happened, you can, not surprisingly, we saw a significant drop immediately in the stock market. But in the narrative at the time was that things were going to get a lot worse, and this was the resumption of the secular bear market that began with the global financial crisis, and bonds were going to go a lot lower, yields were going to go a lot higher, and the stock market was going to go significantly lower from there. But what we know transpired since that the things settled down, we did hit a new lows following the debt downgrade. But in about 6 months, the market was back to new highs again. So we don't want to be complacent. We don't want to automatically assume that this is what's going to happen this time around, because the backdrop from an inflation and interest rate perspective is quite different. But nonetheless, the narrative was quite a bit bearish back then. It's quite bearish right now. And we just want to keep an open mind to the possibility that the market, despite the intuition in the rather reasonable intuition that things are quite negative right now, given everything that we're seeing, the market's trying to tell us that it likes what it sees, that we just can't see it yet. And while that seems hard to endorse or embrace that notion today, that was the same exact perspective to hold back during the last debt downgrade, because the environment back then was very similar to what we see today from an underlying recovery perspective, one stock at a time. So let's cover what's different today relative to the last downgrade, and how it might actually be different enough to result in the market eventually rolling over. Again, that's not our thesis. It's not what we believe. But again, I always believe that once you have a working thesis, you're actually, your time is better spent finding things that run counter to your thesis, as opposed to finding data to support your thesis, because that's how you get blindsided. So if there is something that the market is eventually going to catch up on and start to discount negatively, this could certainly be it. So back when the first debt downgrade happened, of course, this is what happened to interest rates and inflation expectations. So here's where the downgrade happened. To the surprise of most, if we're being honest, interest rates didn't go up, as people didn't rush to the exits and abandon their U.S. treasuries. Instead, it exacerbated the already ongoing downtrend in rates and inflation expectations. So, of course, we know that the environment back then was quite different from what it is today. So this is the environment today, and here's your downgrade. So a very, very different environment. So it's conceivable that this downgrade could be a catalyst to drive rates even higher, and potentially inflation expectations even higher. Now, it's easy to see how that would spill over into the equity market and be a negative catalyst for stocks. I'm all over that. I completely understand it. I would not be shocked if that happened. But as it stands right now, as I've shown you so far, it's just not showing up in the data. The market seems to see something down the road that it likes, that perhaps is not something that we can perceive at this moment. As always, we'll find out later what it is, or perhaps we'll find out later that it just took time for the market to care about these things. But at this moment, from our perspective, we don't see the market paying too much attention to this, or certainly not spinning it negatively, not for the stock market, at least. Here's one way to think about it. This is a theme that we've been harping on for many months, and it continues to play out even after the most recent debt downgrade. So this notion that all of these negative things might drive rotation within the equity market as opposed to an exodus from the equity market. And this chart, I think, does a good job of illustrating that. So this is the 10-year yield, inflation expectations in the American Industrial Renaissance ETF, AIRR, relative to the S&P in blue. And you can see these are basically the same line. And so this chart, this relative performance of this ETF, is one that has been behaving and performing very well in a rising rate, higher inflation environment. So this has been the theme that we've been really harping on, and it continues to play out, that it's been a rotation into cyclical inflation sensitive sectors more so than an abandoning of equities because of this inflation. And as we continue to move forward, we want to continue to monitor these trends. And as far as what we can tell, that trend remains the dominant one, and it's less about abandoning equities as much as it is rotating within. So again, keeping an eye on things that could go wrong and things that could unnerve the market. This is the bank ETF. This is something that we've talked about where we don't think banks need to lead the market for there to be a bull market in broad equities, but we certainly can't have them be a donut hole, and they can't be collapsing and falling apart. And so we've been writing about this recently, and actually since the bank crisis, that we've seen enough stability here to suggest that at least they're stable and the broader market can continue higher. So now what we can do is isolate supports that we really want to see hold during this corrective period. So 40 to 4250 on the KBWB, which is the KBW Bank ETF. We can see it failing here at resistance. That's fine. So is the market. So the 200-day average is right there. It's, how can we be shocked that banks are failing here? What's more important is that we need to see the support hold up. And again, we don't need to see them lead. We just can't see them break supports, much like we can't see the market break supports as well. Another very important area of the market to monitor is the US, the non-US market, the ACWI ex-US. Again, not leading, that's fine, but also not a donut hole, not heading south. Failing at resistance, yes, this was resistance that was in place well before we got there. Now that we're failing there, we shouldn't be shocked. That's what resistance is all about. What's more important is, do we break support? Ideally, we won't break through this 47 to 48 area, because that's the 200-day average. That's sort of be the momentum support, but the trend support is in the 44 to 46 area. And as long as we don't take that out, we don't think that there's a risk of a significant resumption of the bear market. And so that's our working thesis. But again, here's two markets to keep an eye on as we move forward in terms of inflections that might unnerve the broader market. We also want to keep a close watch on the dollar. When you look at periods since the global financial crisis, when you get these big moves higher in the dollar, they have generally translated into very volatile, if not negative, periods for equities. And with the dollar where it's at, where we have we do have this concern that dollar strength from here could at least cap the equity market, if not cause a bigger decline. So here's the dollar index since the global financial crisis. You can see a very large sustained uptrend interrupted by significant basing periods. So our most likely scenario that we're thinking about today is that we're sort of on the doorstep of another sort of range bound environment like this, as opposed to just a big explosive move higher. So holding support at 100, this is a support level that we've been identifying for about a year now, and we've continued to hold above it. We're making progress away from it. And when you dig beneath the surface of not just the crosses that are in this particular index, but more broadly speaking, you can see that the dollar is trending against most popular crosses. It's true that most of those, that positive trend structure is basing, but it's in an up base one, which is a positive basing structure. So dollar strength from here seems probable to us, and it could contribute to equity weakness at this point in time. Again, we don't see the market caring about this in a meaningful enough way for us to take action, but this is something we want to be mindful of. We also, we want to just keep an eye on these support levels for the crosses, much like the support levels I just showed you on the dollar index. Here's comparable supports for the various crosses, and if we start to break these supports, they will, any break of supports here will push these uptrends into bases, and any break of these supports here will push this positive trending structure into negative trending structure. So these are really important supports, particularly these, because these are the line in the sand between positive and negative trend structure for these various crosses. Also want to keep an eye on commodities, because to add to the confusion, they too appear to be on the upswing. So we've taken out this swing high here, which now makes this major support. Again, we can identify resistance well before we get there. We got there on the commodity index. We are failing. We should not be surprised by that. What's more important, do we hold support? So far we have. And when you look at the majority of trends within the commodity space, the majority of it is trending higher. Now, it's interesting that you can break it down into the three components of the commodity space, and you can see that most energy sectors or groups are trending higher. The sole downtrend in energy is natural gas, and most ag is trending higher. And once again, most of the positive trend structure is basing, but nonetheless it's positive. You can see the support and resistance levels here. I've highlighted the support here for you. But this is running sort of counter to the thesis of the industrial renaissance in America. But most of the industrial metals are struggling to endorse any kind of industrial renaissance here. But nonetheless, this is where we stand with commodities. We know commodities tend to move opposite the dollar, but really since 2017, we've seen periods where they've moved together, frankly, more often than not. So we want to keep an open mind. Higher commodity prices here obviously translate into potentially higher inflation, all of which kind of endorses the trends that I just showed you on prior charts. But it's easy to observe these trends, put together a narrative that we ourselves endorse and believe, and then start positioning a portfolio that way. The risk is that we start positioning that way well ahead of the timing in which the market itself actually cares about these things, if it ever does. So what we're seeing from the market level in the equity asset class is that it's navigating all of these confusing trends in a manner that suggests that the market is still basing, the market's looking forward and it likes what it sees, and we want to keep that as our working thesis until the data inflects in the other direction, and we're just not seeing that. So in summary, as I said, it's not at all clear, but it never is until, of course, the top. When everybody can tell you exactly why what's happening is happening, that's when you have to worry. And we can certainly say that that's not the case today. So while we navigate this corrective phase, we want to just make sure that key supports hold across the various asset classes, which we've detailed here in this month's video. We are, at this point, we're leaning towards the US debt downgrade as being less important than most argue, at least for the equity market. It might be more important this time for the bond market than it was in 2011, but as far as the equity market is concerned, the market seems to be more content with rotating within its sectors as opposed to abandoning the asset class entirely. And again, we want to be very mindful that the background is different today. So we don't want to be complacent, but it's all about evidence, and we just don't see the evidence yet. So for now, we see this as a normal correction. In our fund, we've, as always, when we have a trend that's violated at the individual stock level, we always take action, and we're just not yet redeploying that capital until we get into supports and start to see some stability. We do anticipate that will happen, and so we're just spending our time lining up those names that we want to accumulate into this weakness after the signs, after those indications of stability. At this point, inflation beneficiaries clearly stand out as the most probable leadership going forward. In addition to the inflation beneficiaries, of course, the list of the sectors are beyond that, are beyond just inflationary beneficiaries, in the sense that it's discretionary, industrials, tech, energy and materials. So there's a mixture of inflation beneficiaries in there, but there's a lot more to it than just that. So that's what we have for you this month. Thanks very much for your time. As always, anytime you need any further information, please do feel free to reach out to either myself or Rick Casella. You can see our email addresses here, and please, again, reach out to us if we can help at all.